Year to date, the majority of companies in the S&P 500 are up in the green. However, when we take a look at REITs, in particular VICI Properties, it is down around 13%. If you're invested in the S&P, well, that is up 22%, a massive contrast. Now, this is one that I have been adding to in the more recent days, but we are getting a lot more bad news for REITs in general. As we can see, the expectation is now that the US Fed will cut rates just once this year. In fact, this is pretty much the view that is shared by a lot of journalists right across the board. Now, in today's episode, we're going to run through why we've been adding this, what we love about this company. We'll talk about their dividend safety, which is a little bit worrying. It does sit at a 50 borderline safe score. We'll also talk about the growth of this company historically, as well as the expectations for the future. And we'll look at exactly what insiders are doing. We have noted some insider buying, and in fact, institutions will take a look at them quarter on quarter, and we do have some very good news. Now, also, we'll take a look at their investor presentation from last month, really highlighting what we love about this company. And ultimately, we want to put it through the valuation model. We want to give you our intrinsic value, what we see as our acceptable buy price, and the margin of safety we are using on our buys that we have executed recently. So as a quick historical overview, we do get a triple buy rating, Seeking Alpha, Wall Street, and a strong buy from Quant. This is one that is trading right there towards its 52-week lows. It does have a nice yield, which is paid out quarterly at just under 6%, and we do note a forward P to FFO of around 11. Now, year to date, as we mentioned, it has been having negative 13%. The interest rates as a whole that have increased haven't helped companies like Vichi's in the real estate investment industry. Over the last 5 years, though, we do note it is up 25%. Again, if you were to reinvest those dividends, you would be up, although marginally higher. Now, in terms of this company's top line revenue, for REITs, we want to see 5 to 10% growth. What we've noted, 19 million reported in 2014. 3.6 billion in that latest annual account. So we have noted some very rapid growth just over the last few years with VICI Properties, always a good sign. But what we also want to see is their bottom line mirror that in terms of the growth. And what we can see, 43 million December 2017, 2.5 billion in December 2023. So again, very nice to note, just like their top line revenue, their bottom line net income is also increasing and moving in the right direction. What is very important to understand, especially given the fact that we did see this company having a borderline safe dividend score, is the health of the company, their total cash versus their total debt. Now, 2017, they had 184 million on their balance sheet. Latest quarterly report, 485 million. We can see their cash position very inconsistent, but over the longer term, it has increased. Now, we never look at this number in pure isolation. We always compare it numerically and directionally to their total debt, which, as we can clearly see here, 4.8 billion in 2017. It has increased rapidly, 17.6 in that latest quarterly report, as we can see, and now we are starting to understand why they do have that fairly poor dividend safety score. So lots for us to take in, not just into the valuation at the end, but also into our understanding of this company. What I always like to do as well, this part of the analysis, compare how they performed against analyst targets, and what we note over the last 4 quarters, very mismatched. They in fact beat 50% of the time. 2 out of 4 were misses, 2 out of 4 were essential beats. Now, the reason why we use this and look at this is to gain some confidence moving forwards in their projections, although it is up to you whether or not this 50% track record does give you that essential confidence. So over the next quarter that they are due to report at the end of this month, they're anticipating negative 4.6% year-on-year FFO, funds from operation, decrease. Over the next quarter, a very strong increase, and we can just see the inconsistency of this nature. Now, if we look forwards to essentially December 2025, the forward P to FFO will drop to 10.45. As we can clearly see, they are estimating an increase from the previous year. Again, this will be up to you whether or not that does give you confidence moving forwards. Now let's look at some gradings. The first one we're pointing out is the valuation and the underlying metrics, for which they do get a B+. Now, given this is a REIT, we won't look at the typical P on a non-GAAP basis. It isn't relevant. What we do look at is the P to FFO, price to adjusted funds from operation, where they get a 12.39 with the sector median at 14.68. They are trading at a discount of around 16%. Now, do bear in mind, companies will trade at a premium or at a discount for certain reasons. We have to find out whether or not we believe this is warranted, and in fact this is a strong essential opportunity to add more at a very good price. We then move on to the growth grade, where they do get an A+. Now what we can see here, the expected growth forward lookings 6.6%, which is significantly better than the sector median of 1.5%, and the historical year-on-year growth double digit with the sector at 2.3. So right now, already looking like a good opportunity. They are better than the sector in terms of that growth. And when we do look at the historical growth over the last 5 years, it has increased 8.5% year on year, sector median 2.21. So lots to like about this company. We can also note that if you are looking at different metrics here as well, they also do get an A+, again, depending on which ones you do want to use in your own analysis. We then move on to the profitability. They get an A+. Some of this we will cover later on in terms of the payout ratios. Cash from operations though, 2.2 billion, sector median 223 million. So again, we can already understand why this does have that triple buy rating. And just for a conclusion for this part of the analysis, VICI Properties with a B+ on valuation, A+ on growth, A+ on profitability with a triple buy rating, and as we see, Quant giving it that strong buy. Now, we always like to add in here our historical analysis against other companies in the sector. So we have Iron Mountain, Gaming and Leisure Properties, as well as a few well-known others. What we note, so total return, that means including dividends reinvested, VICI Properties is the worst performing. Now, we typically look at this to gain an understanding of the industry, if there are any themes we can identify, or if in fact in isolation this is just a company that hasn't performed well. What we've noticed, pretty much the majority of these REITs, 4 out of the 6, have had negative growth. Now when we expand that to over the last 5 years, what we actually know, Vici goes from the worst performing to the third best performing, up 64%, which isn't the worst result over a 5-year period if you are reinvesting those dividends. But what we should also note, whether you think that is good or bad, past performance is not an indicator of the future performance. Now, investors will have different strategies, whether you're looking for income, whether you're looking for growth, total return, but we always like to compare it to the S&P, because ultimately, if it doesn't outperform the S&P, you could just put your money in a low-cost ETF. Over the last 12 months, well, the S&P has outperformed 23% versus -7. When we expanded over the last 5 years, we also see outperformance, although we do see VICI Properties a lot better when you do zoom out. Whether or not, though, you do have that confidence in VICI Properties over the next 5 to 10 years, whatever your investment time horizon is, do understand that if you don't have the confidence that it will outperform the S&P, then it could well be a very good reason just to look at ETFs. Now, before we take a look at that dividend safety score, just to let you know, we have released our latest free weekly article. We run through some high quality dividend growth companies, our own price targets. If you want access to this or any others, it is all completely free, and you can click on that pinned comment below to gain access and read straight away. Now, what we want to point out here is, typically we look at insider ownership. We always see a lot of insider selling in the majority of companies we analyze. This is one of the first ones where we actually only see insider buying, around $87,000, and we can see 0.25% insider ownership. Now, quarter 3, we have some data. We note no movement. Quarter 2, there was also no movement. So if you want to see that buy, you'd have to go to quarter 1 of 2024. And to see who that individual was, we can see James A., the director, did buy 3,000 shares for around $87,000. Now, we typically do consider this a bullish signal, as insiders buy, as Peter Lynch says, because they believe the share price will go up. But whether or not you think that is trivial and maybe a little bit outdated, as that was the 14th of March, again, that is completely up to you to decide. We then look at institutional ownership, or 98%, 2.38 billion worth of sales over the last 12 months, nearly double the amount of buys, not just over the last 12 months, but what we can also see in quarter 2, 1.35 million worth of buys, 0 worth of sales, as well as the previous quarter where we do see more buying than selling. So pretty bullish if you ask me in terms of insiders. They are buying. We also see institutions buying more over the last 12 months, as well as in the more recent quarter. But as always, do your own due diligence. Never copy what institutions or insiders do. So let's jump into the investor presentation. A few things to note, especially for those who haven't seen this. Just to let you know then, VICI Properties has 13 tenants. We've seen 93 properties. Now, the bulk of this, we should say around 74% of that rent does come from both Caesars and MGM resorts, which are very, very big and well known. The majority of these properties in Vegas as well. The good thing that we do want to point out, even with the increase in interest rates that have happened over the last few years, is that the WALT, so that is the weighted average lease term, is around 41.5 years, which really does hedge against any inflation movements up or down. So that is a great sign. In fact, the top two, one at 31 and one at 51. So no real worries for us in terms of that. And we can also see they are 100% triple net leases, which is always a great sign. Essentially, all the maintenance upkeep is down to the individual tenants. The other thing to note with this company is there is high barriers to entry, and what we can see, in fact, if you were to think about 2020 with the pandemic where most of these places would have been shut, they actually managed to obtain 100% in terms of that cash collection, and we can see for the industry as a whole it was somewhere between 70 to 99%. On top of that, when we do take a look, as we mentioned, 42 years in terms of the remaining lease, we can see others in the sector around 8 to 14. So a lot of benefits with VICI Properties as opposed to others in this industry. And then we move on to looking at this company in terms of their dividend, which we love to see. They've increased their dividend just over the last few years. We'll touch upon this, but as we can see, 7.9% on a CAGR basis, compounded annual growth rate. And we can also see during this time, they were increasing the dividend much quicker than others. In fact, ADC, which came second at 6.1%, we have Realty Income at 2.7%, the average, in fact, around 2.2. So that is another big reason why we do like VICI Properties. They do increase that dividend much higher than an inflationary target of 4%, as well as others in the industry. Again, this is just to show those that are new. They have 54 gaming and 39 other experiential properties. As we can see, this is across 26 states, as well as one Canadian province. And when we take a look at what they are, well, in fact, they are the largest owner of hotel room real estate, as well as privately owned meeting, convention, and event space in America. And we can see here hotel rooms, gaming spaces, F&B, food and beverage outlets, entertainment venues, retail outlets as well. So this is a very, very large company. And on top of that, with the majority of those properties in Vegas, you have to understand that it is essentially a massive entertainment hub. You even have the Sphere now, which is fairly new, and a lot of very, very famous artists who do come here and perform, as well as other sports that we can clearly see here that does draw a lot of attention to this essential area. We then move on to the dividend safety. Now it does sit at 50, so borderline safe. So let's take a look at that. Market cap 29 billion, and we can see their latest dividend increase 6.4% in September. Now it was just reaffirmed in May that that borderline safe score is in place. Therefore, they believe a moderate risk of a dividend cut over a full economic cycle. We can, as we mentioned, that dividend increase last year, and over the last 5 years, a double-digit increase on average. We love to see that, and they have just been increasing those dividends for the last 5 years. Now, in terms of dividend yield theory, again, for those that are new, it does state the company is undervalued when the current yield sits above the 5-year average. So we have an undervaluation signal, pretty strong, one of the highest yields they've offered over the last 5 years. And when we look at the forward P to AFFO, we get a double undervaluation signal, as that forward P to AFFO 12.2 is below the 5-year average. On top of that, it is also below the real estate sector, so we get a triple undervaluation signal. We then move on to the adjusted funds from operation payout. Now, very important, as we do typically look at the free cash flow, it is more volatile for REIT. So we want the AFFO to be below 75 for hotel, pretty much around that every single year. Again, expected around that over the next 12 months. And in fact, in those shareholder meetings they have, this is one of the criteria that they do look to aim for, 75% year on year in terms of the payout. We then move to the AFFO per share, adjusted funds from operation. Similar to when we look at the free cash flow per share, we want increases over the longer term consistently. That is what we get. And again, over the next 12 months, that upward trajectory is anticipated to continue. In terms of sales growth, well, as we mentioned, for REITs, 5 to 10%, we get that and a lot more over the last few years. And when we do take a look at the percentage of the AFFO per share growth, we can see 3 of the last 4 years, 11% over the next 12 months at 4%. So it has been historically very strong, and hopefully we can expect that to continue into the future. In terms of the sales, well, we saw this earlier, just a different format to view. One thing we always have to point out with essential REITs, they do dilute your position over the longer term. It is very typical, you will see this. Some do dilute more than others at a much quicker rate. Reason, well, they do retain little of that internally generated cash flow. They pay the majority out as dividends. We then move on to the ROIC. As always, very important metric. 3 to 5% is what we want to see for REITs. Just give us faith that management are able to effectively allocate their capital pretty strongly, around 5 to 8% over the last few years. So that is always a very good sign. And we can see the operating margin, although inconsistent, is still very, very strong for REITs as a whole. Finally, we get to the net debt to EBITDA, which is pretty much where we do get that dividend safety come undone. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, below 3.5 for hotel REITs, and as always, these numbers below represent the number of years it would take the company to pay off all of their debt net of cash on hand. So as we can see, pretty much nearly every year it has been above that. Now 5.86 in the more recent year is still very, very high. One thing we would say, it is anticipated to come down over the next 12 months, but do bear in mind that is still higher than the 3.5 we want to see for this industry specific. So again, this is why we do get that borderline safe score. Although what we would say is, given the payout ratio is around 75%, and essentially they are increasing that dividend at a very nice rate, the dividend does look to be okay based on this information, as well as the fact that the trajectory is for this number to continue climbing down. If that does stay that way, then this is definitely one not to worry about. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. First model, multiples valuation model, companies in a similar sector and size. We have the average P to FFO as well as that of Vici to get an intrinsic value of $35. So we do get our first undervaluation signal. Just bear in mind that we don't look at any one of these models in isolation. We then move on to the dividend discount model. Now we have that growth looking very strong, 7.9% just over the last few years. We've gone very, very conservative at 4%. Hopefully this September with the increase it will be much higher, and that does give another intrinsic value of $44, showing some very strong undervaluation. We then move on to the third and final, the DCF model with the free cash flow. Average growth, we have gone a lot more conservative with the discount rate to get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we do get an intrinsic value just under $35 with our third and final undervaluation signal. As always, you can grab a copy of this model by clicking on the pinned comment below to get to your own numbers, your own intrinsic value, whether it's for VICI Properties or another company. So the intrinsic value, the average of the three today coming at $38, with the current price at just under $28, we always use a margin of safety of 10%, and we execute on that if it meets the three criteria of the wide moat, strong financial metrics, and good forward-looking data. Well, if you believe that for this company, it is a buy around $34, and then we keep going till it's near the current trading price, and what we can see in today's episode, it isn't quite there at a 30% MOS. You would need to wait for around 26.44 if it ever arrived there. That is pretty much around the 52-week lows, but in today's episode, you are getting a 25% MOS level around 28.33 based on the estimates and judgments. Now, for me personally, a 25% margin of safety is sufficient for this REIT. I do see it as high quality after everything we have just gone through. It does look as well when interest rates do start to cut, this will definitely climb. On top of that, while we do wait, we are getting a yield near 6%. As always though, do let us know your thoughts in the comments below. When we do take a look at Wall Street, well, they are also bullish on this company as we saw a triple buy rating. Their price target $34 with upside of 22% just over the next 12 months. As always, let us know your thoughts in the comments, whether you're adding, whether you're holding, or maybe for whatever reason it isn't one you're interested in. And as always, smash that like button if value was provided, hit that subscribe and bell button so you are continually notified. And as always, we'll see you all on the next one.